Welcome to Glofolio. It's another interesting section with me where I'll be dropping two Nigerian stocks you should buy for double digit gain. Now, I hope you've subscribed to my YouTube channel. If you are yet to subscribe to my YouTube channel, kindly subscribe right now and hit the notification bell. The reason you have to turn on notification bell is that most of the stocks that I'm going to drop, they are time bound. So it wouldn't make sense for you to uh, visit my channel at your own will, whereas there's been a stock that you should have taken advantage of. So the advantage of turn notification bell is whenever I drop a post, you quickly get a notification on the stocks you should be watching out for and also important trading tips. Today, I'll be dropping two Nigerian stocks you should be buying right now. There are a lot of stocks that I've dropped with members of my private community, and I'm going to pick two of these stocks and I will talk about them and why I think these are very good stocks to watch out for, including my analysis of the market. You know me, I talk about fundamentals, talking about technical, and also look at the economic trend and how they affect the market. And most importantly, I am not emotional trader. I trade with data. So let's go on. Now, what you see on screen is the chart of the Nigerian stock market. The Nigerian stock market had been surprising a lot of us, delivering good numbers. This month, the market is up by 3.18%. Now, from January this year, the market actually delivered in January, sorry, the market delivered 9% increase from an opening of 42,760. In February, the market went up by 1.65. In March, the market delivered a negative return of 0.91. And then so far in April, the market is up by 3.18 to 48,459. So if we do 42,716, 42,716 minus 48,769. So that means the market has added 6,053 basis points. 6,053 basis points divided by opening. So which means the NSE All Share Index is up by 14% this year. 14% from January to date. That's not bad. This is a double digit gain. In short, a lot of us have actually expected the market to dip from this important key level at this point because the market had not traded above 44,000 in the last 8 years, right from when TradingView started tracking the Nigerian stock market. You will see from 2013 to 2014, the market found resistance at this level. At this level, you can see the huge dip. And then again, the market traded around this region, was rejected again, and then you can see again the market went out. So it's normal for us to expect a pullback, but at some point the market pulled back. What happened? Market blasted higher. Now, if you were part of my webinar, sometimes I had a webinar with my trading community and I shared important signal that would have actually given us a sign that the market was about to break. And that's what we call hop and handle pattern. If you understand technical setup in my Nigerian market, or if you're used to technical analysis, you should know what we mean by hop and handle pattern. So in hop and handle pattern, you see a market touch a particular key level to dip significantly and then go back to that same important key level. Now, normally you would have expected the market to also dip again, but what happened? Buyers stepped in. So that means that there are influx of buyers, new buyers, who might likely take the market above. And then you see that with 9.5 breakout, the market went as high as 46,905 basis points in January. So, but at this point, why the market is still maintaining a strong bullish run, like you see right here, it's important for you to be careful. Now, why I'm always very careful, why I'm always very cautious at this point is because a lot of stocks might be driven by FOMO, fear of missing out. Nigerian stock market is up by 14% so far. Let me quickly jump in to start buying. And what happened? By the time the dip comes, you are going to be trapped. So the worst thing that would ever happen to you as a trader in this market is for you to be trapped in the market. You need to be sure that you're not buying into a stock that is overbought and overvalued. That's the easiest way to be trapped. A lot of stocks are sitting at overbought region. Overbought region is that region where we've had a lot of buy pressure, and very soon when seller steps in, when this guy turns to sellers, the price is actually going to crash, not even fall at this point. So you must try as much as possible to avoid stocks that are overbought, but rather go into fundamentally sound stocks that are still emerging from the bottom. And then stocks that has huge upside potential, stocks that are showing steady growth and then are also benefiting from the economic trend. So when you buy this kind of stock, What happened? Your downside risk is very, very low. What is downside risk? It means that even if the stock is to dip, you are likely going to cut your loss and then leave, and which means your loss to a very large extent will be marginal. But when you're buying a stock that is overbought, your downside risk is very, very high. But what happened? Upside potential is very low. So try as much as possible to avoid stocks like this. So most times people are so carried away by the massive rally on a stock without looking at risk level. They don't have proper risk management strategy. So if you want to become successful in this market, your risk management strategy has to be top notch. And one of them is make sure that the only stocks you buy are stocks with limited downside and huge upside potential. And then your risk to reward ratio has to be high. Sometimes you could go with risk to reward ratio of 1 to 2. Maybe if you're actually going for a downside risk of 10% or 15%, then your reward should be around 20% or 30%. Once you're 30%, you are out of the market. So without further ado, let's quickly jump on the stocks that I want to buy that I think you should be looking at right now. I own them already. I've dropped um, these stocks in my community for a while, and then we're still holding that stocks. And interestingly, the recent financials, besides, even solidify our take. Besides, it's even giving me more conviction or making me convinced more about the potential of this particular stock. The first stock is Waco, Lafarge Waco. Lafarge Waco. So that's Lafarge Cement. Now, Lafarge Cement is currently selling for 25.55. Now, before I discuss technical analysis of Lafarge, let's quickly look at the fundamentals of Lafarge. This company has just released its Q1 2022 result and it's massive. So let's analyze these results line by line. And then I'm going to show you some of the things that are quite interesting about this company's fundamentals. So let's look at Lafarge Wapco. Okay, so this is the profit and loss of Lafarge. That's for Q1 2022. Now, this is Q1 results against Q1 2021. Look at revenue. Revenue went up to 90.6 billion compared to 71. From 71 in 2021 to 90.6. Then gross profits went from 31 to 32. Very good. Then I'm just trying to summarize it. Operating profit from 14 to 22, despite increase in selling admin and admin expenses. You can see selling and distribution costs increased from 12.6 to 15. Inflationary pressure, administrative expenses from 4 to 5. But despite that, operating profit still came out better at 22.1 billion compared to 14. Profit before tax 21.4 compared to 12.1. Then profit after tax 17.5 compared to 9. That's almost 80 to 90%, which is very, very impressive. And then EPS 1 kobo compared to 57 kobo. Now let's look at something. Now I've been following Waco for a long time. So there's one thing I always like to watch out for in Waco. What's that? I like to watch out for finance costs. Now, these guys have been keen on cutting down finance costs to the barest minimum. And I'm going to show you the trend from 2017 up to date. Now, look at what happened in finance costs. As at Q1 2022, end of Q1 2021, they had 3.6 billion interest expenses. Sorry, 2.1 billion. Sorry for that. 2.1 billion. This is it. 2.1 billion interest expenses or finance costs as at this period. That's what they paid. Now, look at 2022. It was reduced drastically from 2.1 billion to 675, from 2.1 billion to 675 million. Very, very interesting. What could have been responsible for that, for such a massive decrease? Let's go to note 9. Let's go to note 9 on the company's financial statements. Let's go to note 9. Okay, this is it. Now, you see that majority of that finance costs were actually made up of interest on borrowing. So, as at Q1 2021, look at what they paid 1.6 billion. And then in Q1 2022, they paid 388 million from 1.6 billion that was paid in 2021 down. And finance cost, reduction in finance cost is a positive trend, it's a positive indicator because when finance cost reduces, by default, profit before tax increases. There are two major stakeholders in a company when based on the capital structure. We have debt and equity. When you secure debt, you're supposed to pay interest. Equity is supposed to pay dividend. Now, by law, you're supposed to settle your creditors first, your debt holders before your shareholders. So if you're paying higher fee as debt or you're paying higher amount as debt, interest on debt, most likely your profit will be affected. So which means Lafarge is actually enjoying higher interest cover because if I do a detailed analysis of this financial statement, it means that interest cover has increased significantly. Interest cover has increased significantly. So let me do a rough um, estimate of what the interest cover is going to be like. So here, earnings before interest and tax, EBITDA, that's earnings before interest and tax. So here, 22.1, 22.1 divided by, so let me just do this, 22,116 730 divided by 675,734. That's 32. Interest cover is 32. Now let's look at the previous quarter. 14,703,986 divided by 2,104,110. 6 point. You can see interest cover. I'm just doing an estimate. Interest cover increased from 6 to 32. So when you're analyzing a company, how exposed a company is to its debt, it's not just you're not going to be looking at debt to equity alone. Some companies can have high debt to equity and then high interest cover. So what you should be looking at more is the interest cover. You can see how interest cover increased from 6.9 to 32, meaning that the company has enough cash right now to pay its interest without necessarily dipping hands into reserve. This is extraordinary. Let's now look at the trend of this finance cost. Why I'm paying attention to the finance cost is because ever since the company took finance cost as a project that they must cut down in the last 3 to 5 years, I've seen steady decrease in finance costs. Now I went to Capital Cube to look at the trend. Now, this is Lafarge Wapco on Capital Cube. So on Capital Cube, I'm able to see the trend from 2017, 2018, 2019, 2020, 2021 to that's the trailing 12 months. So look at interest expenses. So you can do your calculation here. Earnings before interest and tax divided by interest expenses. That will give you the interest cover. Now, as at 2017, the company paid 40.8 billion. Note 40.8 billion as at 2017. 2018, it reduced to 37 billion. 2019, it reduced to 15 billion. 2020, what happened? 7 billion. 2021, 1.3 billion. Can you see the trend? How the company has been reducing its exposure to debt gradually. And that is an impressive sign. That is a good sign. So that's something to consider when you're analyzing WAPCO results. Now, this is the 2021 financials. You can see here 2021 financials, 2021 against 2020, 293, 230, 142. So you can check this out on the Nigerian Stock Exchange website. They had an impressive outing in 2021. So this says a lot about WAPCO stock. It says a lot about WAPCO stock. Now let's now go back to the technical part, which is where I pay more attention to. Why do I? Why don't I just jump in to buy this stock after looking at the fundamentals? No, I'm always very concerned about timing. Timing is very key when you're analyzing a stock. I need to be sure that I'm buying at a time where buyers are actually taking over the market. Now, look at the key levels I've drawn on Waco shares. I've drawn my key level already. You can see from 2012. Now, I like to analyze a stock from 5 to 10 years back. I don't just look at what is happening today. I want to look at the trend in the last 5 to 10 years so that I can identify certain key levels. And those are key levels that buyers have been watching. Those are key levels that institutional investors are also paying attention to. So look at this has been key level on Waco, which is 36. Now you notice how the company rallied from this up to 114, and then you can see the massive dip from 114 down to back to 35, 36 region. You can see which also tallies with this important key level. I've mentioned it several times that key level is not an exact price. Key level is a region. And then you see another rally again, and then we had a down trend. That's a breakout. Now, let's analyze the trend. Now, this market has shown what we call lower low, which is a sign of downtrend. We have a low here, and then we have a low here, we have a low here. So we have another low here. So each low is lower than the previous low. So that's a sign of downtrend. So we have lower high, sorry, apologies for that. Lower high, lower high, lower high, lower high. So here we have low, lower low, lower low, and then another lower low. And at some point, we're supposed to see another lower low, which is compared to this, but the market formed double bottom. I talk about double bottom and double top. When the market is about to end an uptrend, what happens? It forms double top. If the market is about to end a downtrend, you're most likely going to see a double bottom. But it doesn't mean that the moment you see the double bottom, you jump to buy. Always wait for confirmation. Now, after this double bottom, you can see how Apple rallied from 10 naira up again to clear this. This was a previous level. This region was a previous level. And then you can see how the market broke out from this level and then staged another pullback. So it went from the price of 10 naira in 2020 to a high of 30 naira. You can see the consistent increase, and then the market found resistance, which also tallies with this key level in 2017 and also the key level in 2012. And then the market pulled back to this level. Now, from then, the market had found another support. Then you can see the gradual increase in WACO. Now, are we seeing another trend? We've had previous low, and then we have another low. So this low is higher than the previous low, which is a sign of an uptrend. Now you can see how the market rallied again, and then close to this region, and then it's pulling back. So you can see, so the market seems to be trading above this important region. So as long as WAPCO is above 21 naira, 21 naira, it calls for um cautious look right now. You need to look at this stock critically because going by the recent Q1 result that was just released, so it's clear that this company might actually deliver good numbers. It means that this year, with the companies starting on a good note this year, so it means that the sentiment around WAPCO will still remain positive, and I think you should still hold on to this stock right now. This month, the company is up by 7.8%. So I'm projecting a rally back to this previous level of 30. So WAPCO has 30 naira to contend with. If the stock breaks out from this important region, then we are going to see a big rally back to this next area, which is 55. So WAPCO has 30 naira to contend with. But if it breaks 30 naira, the next huge uptrend of WAPCO should take it to 55 naira. So I'm looking at 50 to 55 naira target on WAPCO if it continues to deliver impressive results, because such impressive results that it has started in Q1 2020 means that we should be expecting higher dividend for shareholders. So what most investors are going to be looking at is, with these impressive numbers, if they repeat the same thing in 2020, in second quarter 2022, then it means WAPCO might declare higher number, might declare higher dividend in 2022, which should be a welcome development, which should be a welcome announcement for investors or people that are holding to this stock. So I think people, smart investors, will want to start taking position on WAPCO stock ahead of year end, going by the impressive results. So the finance cost on that company's line item, coupled with the increase in revenue. So the finance cost did not just contribute to the growth in profit after tax, but the revenue increased too from 71 to 90. So let's look at note 3 to, to understand the breakdown. Note 3, you can see sales of goods from 71 to 90, and then you can see cement contributed 81, 87, and then the next one aggregate and concrete. So the company is actually in line. The company's result is not bad and is still in line with expectations, knowing fully well that a lot of companies now right now are increasing prices to cover up for increase in finance, increase in operating costs. So WAPCO is a company you should watch out for right now, because if WAPCO breaks out from 30, then 50 is my next key level to watch right now. So WAPCO is one stock that I'm going to pay attention to, and I'm going to hold it. Any pullback on this stock, I'm going to take advantage of that pullback to buy more, because the impressive number for me tells a lot about what will happen to this stock in 2022. I hope that is clear, but please make sure you do your due diligence on this company. What's my risk level on WAPCO? My risk level on WAPCO is below 20 naira. This stock dips below 20 naira back to 19 naira. I will consider an exit, because that's my means that the trend has changed. But as it is right now, we have higher low form right now. So if the previous low is broken, then I might probably want to sell off the stock to cut my loss. But right now, the bullish run on WAPCO is still intact. So that is WAPCO. What's the second stocks that I would be looking at? I want to be looking at. Now, the disadvantage, one thing I don't like about this stock is like it's not too liquid per se, but you might want to give it a try if you're not going to trade a large amount of money. That's Ikeja Hotel. Ikeja Hotel. Now you can see the trend line on Ikeja Hotel, how the company is respecting the trend line, both on the downside when it was down until it was broken, and then to the upside. So you can see Ikeja Hotel is forming higher low at this point. This is a low. This low is higher than the previous low. The next low is higher than the previous low. The next low is higher than the previous low. And then we have the high right now. So I expect this company to trade within this trend line until there is a break to the downside. So this might be another stock to watch out for right now. This month the company is up by 17.5%. So let's look at the financial results of Ikeja Hotel. Now Ikeja Hotel delivered not so bad. Result is also good. Now, revenue increased from 5 billion to 9.6 billion. Cost of sales 5 to 7, despite that gross profit increased. So we can see that the company declared a loss in 2022, a loss of 412 million. And then what happened? In 2021, it reported a profit from a loss of 412 million to a profit of 2.6 billion. So this is an example of a turnaround stock from a loss. When a company move from a loss-making position into a profit position, it's likely going to drive a lot of activity. It's likely going to attract a lot of buyers. So buying a company that went from lower profit to higher profit is fine. But buying a company that went from a loss to a profit, you can't expect the movement in both share price to be the same. The one from profit to another profit would not be as high as the one that went from loss, because most likely when a company declare loss, investors are going to dump the company's stock completely. People that are holding for long term, some of them are even dump, especially if it's not even paying dividend. So this is not a bad result from 412 billion to 2.6. And then look at operating profits from 6 billion, which means they reported a loss of 6.5 billion in 2020 to 1.13 billion. So I think this was actually that COVID era. You understand? So it's likely that that might actually impacted this company negatively. And then you see 2021 showing a massive turnaround from 6 billion to 1.1 billion. And then profit before tax from 7 billion to 200 billion. So in general, the COVID in 2020 did affect the company, and it was very obvious right here. And then 2021, the company showed impressive turnaround, how that uh, the government lifted lockdown and then allowed businesses to operate as usual. And you can see how it also impacted on the financials of this company. Profits after tax from 6.7 billion in 2020, and then you can see a loss. That means it was actually narrowed down completely. So profit before tax here. So why? What happened? You can see the reason was the income tax paid, not income tax paid. Sorry. So look at what happened in 2020. Profit before tax of 7 billion, and then here when you minus this part, yeah, I think this like a credit. Yes, this is like a credit. And then you see in 2021, they declared profit before tax and then it's deduction. So this like tax credit, sorry, like a tax credit, yes. So that's why the profit after tax or profit or loss after tax reduced right here. And then at the end of the year, now what you should be looking at more is the profits or loss compared to the previous year. So there's a significant reduction from 6.7 to 180. So like they narrow down their loss significantly. So depending on what happened in Q1, it's likely that this company would declare profit at both the top and bottom line section in 2022. So how is that playing out in the company's stock? If you look at this, we've seen a bit of a massive uptrend. Now, this was 2020. You can see from July 2018, 2020, 2019, and then it's 2020. You can see the downtrend. So there's been a gradual recovery from that time up till now. So as the price of food keep increasing, I think one of the things that this company will benefit from is increase in price of food because most hotels they are also reviewing their prices to cover up for increasing costs, which can also help boost operating margin. So let's look at note 32. Note 32. You see here, room sales 2.9 billion to 5.7 billion. Then can you see food and beverage 1.7 to 3.4. This is almost 100% increase, food and beverage. So it's likely, at least at some point in time, if you find yourself to go to hotel to get food, you most likely see that the price of food in hotels have increased. Most companies are actually passing on costs, increase in operating costs to their customers, and that's also going to help boost their margin to a very large extent because I know that if a company wants to increase its price, it will most likely factor in not just the cost but also profit expectation. So you can see how that rubs up on food and beverage on Ikeja Hotel financials. So going by these financial results and how this company has been trending right here, so you can see here with the higher low formation, it's most likely that this company will continue to trend upward into 2023. So that's why Ikeja Hotel is a stock I think you should be looking at. But one of my challenge on this stock is that when you factor in volume, when you factor in volume, the average volume traded. So you can see the volume traded on this stock is around, look at this section here. It's around, you can see 5.1 billion, 5.1 million. So 5.1 million multiplied by 1.4. 5.1 million multiplied by 1.4. So it means the value traded is 7 million naira. So if you're going in with an amount that is more than 7 million naira, it might not be, this might not be the stock. You might probably will consider it illiquid for you to trade. But if you're actually going in with like let's say 500k, 600k, 300k, 400k, you might actually consider buying the stock. My advice is don't always buy a stock or don't always buy more than 10% of the value traded on a monthly basis, especially when you are trading that stock. This stock, the value of this stock is around 7 million, 7.1 million. So is it advisable for you to buy with 3 million or 4 million naira? Capital no. Capital no. Now I'm not saying you won't be able to buy the stock, but Ease of entry and exit is also very important. You wouldn't want to buy into a stock, see your company stock or see your stocks in green and then find it difficult to sell because of liquidity. So most times it's important for you to look at liquidity of a stock before you consider the percentage or the number of units you want to get. That's why most people prefer banking stocks. You can move in 10 million to a bank stock today and tomorrow you're out of the market. The liquidity is there. There's easy entry and easy exit from the stock. So when you're considering buying a stock, make sure apart from fundamentals, technical. Also, do your due diligence by looking at liquidity position of that company. This is very important. You can see so far this month, 5.6 was traded. Last month, 2.1 million units, 5.6, 2. So between 5.6, 2.1 million or there about. So this is the stock. These are the stocks that I think you should be looking at going forward uh, probably like 3, 4, 5, 6 months trend. Now, I have other stocks that I've already dropped in my private community, and some of them are doing extremely well while we're waiting for some to pick up. But as long as the fundamentals are sound and as long as they are still above our risk level, we're still holding on to this stock. And then while expecting their financial results. Now, if you're yet to join my community, you can actually drop a comment. The Just drop a comment or send a mail at look at the description below. You will see my email there. You can send me an email. I will definitely respond to you. So, like I said, please make sure you turn on notification bell so that whenever I drop stocks like this, you can quickly get an alert and then take advantage of the buy opportunities that I'll be dropping here. Please, every information I share right here, I'm not a financial advisor. Please make sure you do your due diligence. Make sure you consult your financial advisor and make sure you also run your own check based on your own risk profile to determine whether it's appropriate for you to buy the stock or not.